Options on financial markets are the right to buy the underlying contract, whether it be stocks, stock indices, bond futures, bonds, gold, copper. You're buying the right to buy that at a given price when you buy an option. Options are divided into two sorts. There's calls and puts. Calls are the right to buy, puts are the right to sell. If I buy a 1,000 December ICI call, it means I've bought the right to buy ICI in December at 1,000 pennies. If I pay 10 pennies for that, that is the price of my option. If ICI goes up in price the day after I buy that right, say from wherever it was to much higher, the right to buy it at 1,000, whatever it was, will now go up in value too, because it means the likelihood of ICI being above the 1,000 pennies price in December is higher. So this strange notion then arises of a derivative market based on the underlying market. It's a market in rights. And puts are the right to sell. And you can buy and sell the right to sell something. And that's called puts, and their price too goes up and down in relation to the underlying. The actual pricing of these options is very complex and needn't concern us now. But suffice to say that when volatility increases, all option prices increase. When volatility drops, all option prices, both calls and puts, drop. And when the underlying moves, when the underlying goes up, the right to buy something in the future, the value of calls goes up, and the right to sell it in the future goes down. And similarly, when the value of gold goes down, the right to sell gold becomes more valuable in the future, and the right to buy it in the future becomes less valuable. That's a fool's guide to options.